You paid it this morning. Not income tax, not sales tax, not some hidden fee buried in a contract. You paid it when you bought coffee, when your salary hit your account, when you checked the price of groceries and quietly noticed it was higher again. You paid it and no one sent you a receipt. This is the invisible tax, and almost no one talks about who actually collects it. Right now, this matters more than it has in decades. Prices are higher, savings feel smaller, wages lag behind headlines. Governments debate tax rates loudly, they campaign on them, they argue about fairness, but the most powerful tax in the system doesn't pass through parliament in the usual way, it moves through money itself. Let's start with something simple. Imagine you earn $1,000 this month. You plan to use it next year. If prices rise 8% over that year, your $1,000 now buys what $920 used to buy. You didn't spend $80, it just evaporated. No official bill, no line item, no vote, just less purchasing power. That loss has a name: inflation. We're told inflation is an unfortunate side effect. Supply chains, oil prices, global shocks, too much demand. Sometimes that's true. But inflation isn't just a weather event. It's deeply connected to how modern money is created. Here's where the system gets interesting. Most people assume money is created when governments print it. In reality, most money is created when banks issue loans. When you take out a mortgage, the bank doesn't hand you someone else's savings. It creates a deposit in your account. New money enters the system. Loan by loan, credit expands. More credit means more spending power circulating in the economy. When credit grows faster than goods and services, prices tend to rise. Now, zoom out. After financial crises, recessions, or pandemics, central banks often lower interest rates, sometimes dramatically. They may also buy government bonds or other assets, injecting liquidity into the system. The goal is stability, prevent collapse, encourage borrowing, support growth. But cheap money has side effects. It encourages more debt. Governments borrow more because it's affordable. Corporations refinance and expand. Investors take more risk. Asset prices climb. Stocks rise. Real estate surges. Financial portfolios swell. If you already own assets, you feel wealthier. If you rely mainly on wages and savings, rising prices hit differently. Here's the uncomfortable math. Inflation reduces the real value of existing debt. If a government owes $1 trillion and inflation runs high for several years, that debt becomes easier to repay in cheaper money. In other words, inflation quietly transfers value from holders of money to borrowers. Who are the biggest borrowers? Governments, large corporations, highly leveraged investors. Who holds most of the cash and fixed savings? Households. When inflation rises, savers lose purchasing power. Debtors see the real burden of what they owe shrink. No legislation required. That's why inflation can function like a tax. It reduces the real value of your cash without directly charging you. But who collects it? Not a single person. The collector is the system of incentives. Governments benefit from growth and manageable debt burdens. Central banks aim to avoid recessions and financial crises. Markets reward expansion. No one stands at a podium announcing, "We will reduce the value of your savings." Instead, policies are framed around stability, employment, recovery. And to be fair, deflation, falling prices, can be even more destructive. It can freeze spending, collapse asset values, and trigger debt spirals. So policymakers walk a tightrope. Too little inflation, and debt becomes crushing. Too much inflation, and purchasing power erodes quickly. But here's the contrast that rarely makes headlines. Public debates focus on tax brackets, corporate rates, sales taxes. Meanwhile, a sustained 5% inflation rate can quietly erode nearly a quarter of purchasing power over 5 years. No parliamentary drama, no televised vote, just compounding arithmetic. There's another layer. Inflation doesn't hit everyone equally. Asset owners often see the value of their holdings rise with inflation. Real estate and equities can adjust upward. Wage earners depend on salary negotiations, which lag. Fixed income retirees depend on adjustments that may not fully keep pace. So the invisible tax isn't evenly distributed. It's selective. It nudges wealth in certain directions over time. Now add one more piece: expectations. If people expect prices to keep rising, they change behavior. They buy sooner, they demand higher wages, businesses preemptively raise prices. Inflation becomes self-reinforcing. To break that cycle, central banks may raise interest rates sharply, which introduces a different kind of pain: layoffs, slower growth, tighter credit. Suddenly the invisible tax shifts form. Higher rates increase borrowing costs, mortgages climb, business expansion slows, asset prices cool. One lever, different consequences. Over the past decade, many economies ran historically low interest rates. Money was cheap, debt expanded, asset prices soared. Then inflation surged. Rapid rate hikes. Households felt both ends. First rising prices, then rising borrowing costs. The invisible tax isn't a conspiracy. It's a structural feature of a debt-based monetary system. Money is created through lending. Lending expands and contracts with policy. Policy reacts to crises. Crises often follow periods of excess. And through it all, the purchasing power of money shifts. Quietly. Daily. So when you notice groceries costing more, when your savings earn less than inflation, when your rent resets higher, it isn't random. It's the result of how modern economies manage growth, debt, and stability. The uncomfortable question isn't whether inflation exists. It's this: in a system built on expanding credit and rolling debt forward, can the value of money remain truly stable over the long term? Or is the invisible tax not an accident, but the price we pay to keep the entire structure standing? If you want to understand how money really works, subscribe now.